Sarah, St. Louis Fed President Jim Bullard saying that he can't rule out a 50 basis point rate hike at the upcoming March meeting, and he said he advocated for one at the last meeting as well. He says he sees a policy rate in the range of 5.25% to 5.5% as appropriate.
Welcome back to the Warlords of Wall Street. Today was a busy day. It started first off in the morning. The PPI numbers came out higher than expected. The estimates were for up perhaps about 0.3. Turns out that it was up 0.5. This didn't make anybody happy, and the Federal Reserve regional executives continued seeking their 15 minutes of fame. We had another stranger jump out there and respond to the hot PPI numbers and claiming that, after all, maybe the Federal Reserve should have raised by 50 basis points, not 25. Perhaps this was a mistake and that these PPI numbers were evidence of that. Well, the market didn't like hearing that at all. Matter of fact, the market hated that commentary and remained most of the day volatile as all get out. Add to that commentary is that the politicians are now arguing over us maxing out our debt ceiling again and having to raise it. This is becoming an annual rite of passage in Washington to where everybody's arguing about the fiscal irresponsibility of the government as a whole. And whether you're a Republican or a Democrat, liberal or a conservative, the one thing I think we can all agree upon is that the folks up in Washington have no damn idea of how to run their books. And this debt approaching over $30 trillion is no joke, especially when you factor in that because of the pandemic and whether you want to lay it at Trump's feet or Biden's, we have seen the debt go up substantially over the last 4 to 5 years. And this, when it was going up and we were borrowing at effectively a zero interest rate, the rest of the world was dealing with negative real interest rates. We were pretty close to zero. Then it's almost free money, if you will. However, that has changed dramatically, and here we are having spent ourselves into a hole. And with the Federal Reserve now moving interest rates up to the terminal level of being 4.5%, 5% here very shortly, is that when you're able to borrow at zero, and now all of a sudden that debt is costing you 5 times more, that's going to end up affecting your solvency. And this is becoming, well, we're already borrowing money, floating bonds, just to be able to service the interest on the debt. Hell, we can't even come close to paying it down. But this becomes a never-ending violent circle. And now we're approaching the debt limit again as set by Congress. And now they're going to argue and pass this hot potato back and forth between them. The Republicans are going to say, you're going to agree to certain things or we're just not going to vote it. We're not going to vote to approve to raise the ceiling. Well, this is a dangerous game of chicken that we're playing, is because the whole world looks at our sovereign debt, and this is what the world goes by. Everybody wants to buy our debt because we have always been one of the most stable economies in the history of the world, and even when times are bad elsewhere, people know that they can count on us to go ahead and honor our debts and being the best economy on earth 9 out of 10 times. Well, when you start waving a flag that you may end up having to get into a technical default, then you're playing games with the AAA ratings that Moody's and Standard & Poor's put on the debt. That has a systemic effect on the rest of the markets, and that is just bad policy, but here we are. And because of that, you add those narratives to what is already a market that has gone up 8%. The boys on Wall Street, and we jokingly refer to them as the warlords of Wall Street. The S&P is up 8% already this year. It's not surprising that the warlords would seize any bad news to pull the market back and down some, because this is the way it works. This is the way the game is played. It's been played like this for generations. The average guy was never intended to be able to enter into the market and be able to outperform the institutions. Back in the day, we referred to them as member firms. There's a reason. This is their club. This is their sandbox. They are the members. And now these major institutions, they continue to control everything about it. make no bones there, they control everything. If there was ever a rigged game, it isn't in Vegas, it's on Wall Street. And the way the game works, and you have to think like an institution, you need to buy low. And in order to buy a good company at a low price, there's got to be bad news afoot. And that gives you your opportunity to buy low. Today was one of those opportunities with Tesla, one of the few positions in the portfolios that we've recommended at this point. They happen to have, notwithstanding that the market was a challenge in and of itself today, Tesla comes out and surprises everybody by telling them, hey, we've got 300 and some thousand cars out there that have a programming problem with the autopilot, the self-driving mechanism, and we're going to have to recall 300 and odd thousand of these things. And now all of a sudden, here we go. Although we came at a good price today, giving back $12 was no fun at all. And now with the razor thin profits that they were looking at because of the issues and challenges they had in China, which because China was opening up, we thought they would navigate through that. Now here we go. What razor thin profits these fellas might have had might very well evaporate with the expenses associated with bringing in 300,000 cars across the country. Tesla's already famous for struggling with repairs and parts and what have you, but now they've got to fix them. They have to fix them for free and send them right back out there. This is not going to be fun, and I expect to see probably the volatility in Tesla continue a little bit till somebody tries to wrap their head around exactly what is this going to cost them and how will it affect their earnings going forward. But coming back to the tails which wag the dog, we also had some consumer debt numbers come out today. And it turns out that debt has rocketed up to levels not seen in 30 years, which means we're going to have to keep, that's a bad sign, by the way, is especially with interest rates going up, and we're going to need to keep an eye on defaults because that could end up being one of the shoes that drop that could change the narrative on the market as a whole. For the most part, the market was down over 1% today, each one of the indexes. We saw a tremendous amount of volatility. And I don't think we're going to see that end anytime soon. And it's the combination of the narrative of about the debt ceiling. It's going to be inflation being stickier again. These producer price index, the manufacturers, are telling us that inflation is being sticky. We spoke of that yesterday when we were talking about the consumer's price index. We're seeing that the prices that Kraft charges for a box of macaroni and cheese are just not coming down like the Federal Reserve or we would like to see, and this is going to make things more difficult. So as we've continued to iterate, what we want you to do, take your profits where you can get them. That's why we're going to go ahead and shorten up our window where we may very well be taking, when we see a 10% profit, we may be taking that out and going ahead and returning the cash, hoping that we can play this volatility a little better. If we're going to continue with these sticky numbers, the volatility will be innate in the market. We're going to have to try to keep ourselves from riding this dragon up and down, up and down. Today you make some money, tomorrow you give it back. Nothing is more frustrating to a professional money manager, and this will be a really good test of not only our particular skills, but those of the competition and everyone else out there. How are you picking individual stocks? Because playing the indexes is going to be difficult. The fact that, as I mentioned, the S&P is up 8%, no small wonder that they may even want to try to pull it all the way back, because 8% is 8 to 10% is what the S&P averages in the course of a year. To already have banked that in a month is extraordinary. But that's kind of the way a good year works when there's what we call the January effect. Everybody's back from vacation at the end of last year. You've eaten your turkey. You've opened your presents. You've done all the vacation time. You're over your hangover for New Year's. You get back into the office within the first week or so of January. Business is back to normal, and you have to hit it. Well, Wall Street is not any different than the rest of Main Street USA in that respect. It's time to get back to work. January was a pleasant month. We made some nice money there, and here it is. It's going to stay bouncy. It's going to stay bouncy until the second quarter. And we're just not getting the kind of news we'd like to see with these PPI numbers. That just means more volatility, and it means we're going to have to be more aggressive about protecting our profits. So, as we say every day as we sign off, be careful, keep your powder dry, and we're going to get plenty of opportunities to pick up some stocks, make a few percent here and there, turn them loose, count our profits, and count it all the way to the bank. Be good, be safe, and we'll talk to you tomorrow.